Welcome, everyone. We will get started in just a few minutes. We'll wait for a few more people to join the call. Stay tuned. So, good afternoon, everyone. My name is Marianella Collado, and I'm here with Matt Sainholtz.
Good afternoon.
So, we hope to walk you through the COVID-19 virus and the impact on the market and go over some of our insights and, more importantly, the opportunities that are presented in the current market environment.
Sure, just a little housekeeping before we dive too far into today's discussion. We are presenting general information today. This is not specific to you or your situation. If you have any questions about what is presented today and how this might affect your portfolio, please do give us a call or speak to your Tobias Financial Advisor representative to make sure that your questions are being addressed. Also, at the bottom of the webinar tool, you should see a Q&A and the ability to type in questions. And feel free to put questions in. We have a few minutes saved at the end for some questions. But if we don't get to them, we will surely do our best to reach out to you and make sure that we've addressed your concerns.
So just a little introduction. So again, my name is Marianella Collado. I am the CEO and Senior Wealth Advisor here at Tobias Financial Advisors. And I am here with social distancing, respecting the social distancing guidelines. I am here with Matt Sainholtz, who heads up portfolios. He's our Chief Investment Officer. So while we do have investment committee meetings, we basically have Matt pretty much lead the portfolio management. So it's very timely for him to address a lot of our client concerns and, more importantly, as I mentioned earlier, the opportunities. So today we will cover the current situation with the COVID-19 coronavirus. Now, we're not health professionals. We don't want to try to present ourselves as that, but we'll go over just some general data on the virus itself. We'll cover what the impact has been year to date on the financial markets, maybe a little bit about what the expected impact is on the economy as well as its recovery. We'll go over the characteristics of a bear market, the time frame for bear markets, and more importantly, how do we prepare for bear markets? I've been saying all along that events like this really put a lot of the financial planning that we have been so closely working on to the test. So we'll go over what that means and, more importantly, what are opportunities that we're looking for within portfolios at this time. So a little bit on the novel coronavirus. So this is data that's presented by McKinsey & Company. We don't like to obtain our data from any particular media outlet, as we know that depending on the network, the data may be skewed one way or another. So we go straight to the source just to be able to have a little bit more clarity on really what's happening on a global scale. So as you can see, most countries have really dived into containment efforts, as has the U.S. And nothing really has changed with the virus. It's still out there. The spread is being controlled with the whole concept of social distancing. So one way to look at it is that this is like, and us Floridians, we know what this is like. This is like that hurricane that's approaching us, and nothing's changed. It may be inching closer, but the magnitude hasn't changed, and the impact, if it hits us full on, could be very deadly. So this is one way to look at this particular virus. And one of the things I'll just mention on this is that while the data's out there, I think a lot of the experts are saying that South Korea is probably the best example to use in order to determine the actual mortality rate associated with this virus. Because early on, they started implementing pretty widespread testing. And so out of the $400,000 test, their mortality rate was more along the lines of 1.6%. So, one way to look at that is that even if it's half of that, it's not something that is taken lightly. So that's why it becomes that much more important for us to really adhere to the social distancing guidelines. Because the idea is that if we can plan the curve so that we don't overwhelm our healthcare system, while we're also in the process of trying to come up with some sort of solution for the virus, which can take 12 months to 18 months and hopefully closer to the 12-month period. So this is the current trajectory, and I know there's been a lot of talks about the increased cases in the U.S., but I think it's important for us to recognize that as we expand testing, as we have been doing across the country, the number of cases will be on the rise across the nation.
And we had good news over the weekend. If Abbott coming out with a 15-minute test that was green lighted by the FDA, so we are going to see a significantly amount of more in testing. So to get a better handle on it, a lot of the doctors and medical professionals are saying you really can't fight the problem until you know what the problem is. So that's going to be huge for actually attacking this virus and getting better data and better clarity on just how far and how spread this is. So I think that's a productive and encouraging sign.
Yeah, and I think, back to the, why it's so important for all of us to continue to adhere to social distancing is that one way to look at this virus is, the social distancing is almost like the foot of the neck on the virus. And, we have to continue doing that, because if we remove our foot from the neck of the virus, it will continue to spread. So that's why while we're trying to figure out the solution for the healthcare crisis, it is important for us to try to control the number of cases that, continue in the near future.
Yeah, just to reiterate, this is from China. Of course, there's a lot of, this slide is kind of the timeline of what happened in China over the weekend. Again, depending on what media outlet you're watching, there's question as to how much or the proper reporting happened in China, but basically, you see the peak and then it decreased. So, the United States, we're on the upswing here. I think any news outlet or anyone that you listen to will tell you that we're still on the upward swing of just how many cases we're going to see here in America. So we're only in the second or third inning of the healthcare crisis. But at this, just as much as we're not out of the woods yet, also leads to at some point we will be out of the woods. And we always got to remember that. We always have to remember that at some point we will take care of this virus and we will move forward. So that was our quick update on where we are with COVID-19 and just some food for thought about what's been happening in the health care space. So, what's happening in the markets? Well, wow, what a couple weeks that we've seen. We've witnessed the official end of the longest bear bull market in history. We've witnessed one of the fastest bear markets in history. It's just been the breadth and speed of what we saw in the last month, 4 or 5 weeks, has been really incredible. And we're not going to be here today to tell you that there's not some still uncertainty out there in the economy and the markets. There's still a lot of unanswered questions, but we're here to provide some sort of framework on how to think about this in the context of a long-term portfolio and how to think about this to control your emotions. So, we got to remind ourselves what the stock market actually is. The stock market is business. It is how the companies that deliver you coffee in the morning, the companies that make you a car, and the reason why you invest in the stock market is to get profits, a share of the profits from that business, from the economy as a whole. And so we saw this really big decrease in the stock markets recently, but we've also seen that we have to realize that the world will continue, and there's going to be some bad data ahead, and we're going to talk a little bit about that in just a minute.
Right, and since even though we're going to see some decline in consumer spending in certain areas, many areas of the economy, we've also seen, that there's actually increased spending in other areas, a la, toilet paper as an example. So a lot of hoarding has happened with the development of the crisis. So again, our job is to remain steadfast on our original plan, and throughout moments like this, look for pockets of opportunity to be able to basically capitalize on the current market conditions. So I have a couple more comments here, and I don't know if you were going to talk about the fixed income a little bit.
Yeah, well, I mean, that what we saw, I would say, in the last 4 or 5 weeks was not only just the concern about what's going to happen to the economy, but also a liquidity crisis. What I mean by that was everyone was pretty much rushing for the exits, whether that was in the stock market or the bond market. Everyone was kind of rushing to cash, and there was a tremendous amount of even like there's anecdotal evidence and hard evidence that even bond funds were strapped, and even high quality bonds were becoming illiquid. There was just such a demand for these types of products that the economy across the board, that was part of why the stock market fell so fast, because we weren't sure that with this healthcare crisis going to also turn into a very significant financial crisis. We're not out of the woods yet again, but what we've seen from the Fed, what we've seen from the U.S. Congress and central banks around the world, they've really come out and really have been impressive on how far and how vast of support they are trying to fight this virus alongside of the healthcare world, and the fact that they're just providing liquidity out there to companies and governments around the world to make sure when someone goes to the bank and they want $1, they're going to be able to get $1 out of that bank. And so that's been really impressive and really encouraging. And we can contrast that back to 2008 and the Great Depression, and we'll touch on some of these ideas later on in our slides in our presentation. But the breadth of just the willingness of the Fed to recognize that this has been a huge, it is in front of us, a huge, the idea that we have the support of the Fed to come in and make sure that we have the liquidity to make things meet. So that's been a tremendous.
Right, and I think there was support across all particular aspects. So just a quick thing to mention here is, with the Fed almost throwing everything but the kitchen sink at this, from an individual perspective to corporations, the fixed income arena, liquidity. One of the things that we should remember with this is the Fed trying to hold us up while we're in a state of, I love this phrase, suspended animation. So what this is designed to do is that even though we might be coming into a very deep recession, the impact of this entire stimulus package is to make sure that the individual worker, while they may not be able to go to work, they're not completely impoverished. They're not able to not feed themselves. And companies, while they may see a decline in revenue, they're not filing for bankruptcy. There's so many programs out there that were designed to basically hold up not only the individuals, but businesses across the country. So this is really impressive, the fact that they've really reacted, and as quickly as they did, to be able to hold us up during suspended animation, which is probably the best visual for what's happening at the moment.
Yeah, very, very great point. I mean, we have benefits from people that are in the gig economy, those types of self-employed individuals, all the way to big business. I mean, there's support out there, and we're going to look to see what's been happening in the markets and how the markets are going to react. So how have the markets done? This is a chart from the S&P 500 going back to 1996. You can see, again, we're coming off a very fantastic bull market over the last many years. And so you can just see the straight down at the end of the right hand of our chart where the S&P 500 is down around 21, 22% coming in. This day is actually as of Thursday, March 26th. But basically the S&P 500 is down in the low 20% range after being as far down as probably in the neighborhood of about 35% in the worst of it. I mean, we came off a great week last week with the S&P 500 returning 10% off the bottom lows. And so, obviously we've seen a lot of destruction. And I think that part of that fear, of course, there's still fear. We don't know what's on the horizon. But as we mentioned earlier, that liquidity crisis of just everything being sold, I think that part of the story here is hopefully coming to an end with the fact that the Fed and central banks around the world are supporting the bond markets out there as well. Again, this has affected many sectors, some more substantially than others. I'll have you look on the left. This is a very busy chart, so we won't spend a lot of time with it, but we will be able to share these slides with anyone if they would like to. We're also going to be providing a recording of this webinar for anyone that would like to listen again. But energy is having a double whammy. And energy not only is having a demand effect from basically a shutdown of the global economy on the demand side, but then also on the supply side, many oil-producing countries are continuing to put out more and more and more crude oil, which is also the supply. So the energy sector is getting kind of a double whammy of sorts, and that's why their year-to-date return as of March 26th is around 48%. And then, contrast that with technology, which is only down about 9%, and some healthcare that have held up, only being down 14% as of that date. So, it's widespread, and, not surprisingly, it's always a good reminder, diversification matters and works. Imagine if you were invested in a lot of single companies, a lot of single stocks in the energy space, your portfolio would be tremendously devastated. But, contrast is the way we invest and just the diversification approach in general, it proved that it still works over the long run.
Right, and this slide to me, Matt, also points out where we're looking for pockets of opportunity, while we're down here is looking for opportunities to shift, make some tactical moves in some of these really hard-hit sectors that we know eventually will recover, right? We're all, in social distance and self-isolation at home, and everyone's pretty, much itching to get out there and book the next vacation and go to the nearest restaurant. So, once we get over this health crisis hump, what will happen is a lot of these sectors will go back to the health that they had pre-coronavirus. So that's something that as wealth managers, we're constantly keeping an eye on. This is why as much as we talk about remaining steadfast and staying invested, that does not equate to falling asleep at the wheel either. It's looking for these pockets of opportunities so that when the market does rebound, your portfolio will be able to get to that recovery a lot quicker because of the tactical shifts inside your portfolio, which we'll talk a little bit in more detail. But I think this is a good slide to really showcase what are some of those sectors that have really felt the impact of the COVID-19.
And just one last thing on this chart as well, the dividend yield across sectors and across the S&P 500, dividend yield is about 2.5% from stocks paying dividends, and we'll touch on that for a moment, but 2.5%, I'm going to remember that number. Again, fixed income, which are the bond funds, traditionally the more stable part of the portfolio. If you look on the far right, and these are different time periods in history where there was volatility in the fixed income market. We're coming off for the far right, where even in intermediate core bonds, different types of bond funds, and then the red is the stock market as identified by the S&P 500. As you can see, as we were saying, it's more like a liquidity crisis the past 4 or 5 weeks. Even bond markets were getting hit just as much as your stock portfolio. Diversification works, so it's not as bad as the stock market, but since in the last week or so, since the Fed has come out and done a lot of these programs, we're starting to see this taper off a little bit, and we fully expect to see in the long run that the traditional way the stock markets and bond markets correlate will still be true. It's not that they're always going to go down together. That's the last thing that we are forecasting. You're going to see that return to have the fixed income kind of be our security when the stock markets are going up and down. But just like I said, in this unknown pandemic era here in the last few weeks, in this liquidity crisis, you saw bond markets going down as well as the stock market going down. This chart here is a little busy as well. We've used it in the past. I will quickly go through it, but the gist is across the top is the different years, and the different colors you're seeing from left to right are different asset classes. So let's pick year to date with the black box around it. If you see up and down, the best performing asset class is fixed income. Again, the bonds is up about 2.2% year to date as of March 26th. And then as you go down the column, you will see that cash is basically flat, and then a balanced portfolio down about negative 14%, so on and so forth. You can see U.S. large companies down 18%, commodities down, developed markets across the globe, that's Europe, stronger countries in Asia, real estate down 23%, emerging market down 20%, small caps down 29%. So I guess we're illustrating here that it's been a breath of no asset class really was saved. But then when you look at the balanced approach, and this goes back into the time frame of history, when you look across the left in different time periods, if you go back to 2008, and during the financial crisis, we had stock markets down in the 37% area in the U.S. and emerging markets down 50%. And your balanced portfolio was down 25%. This speaks to diversification and also staying the course as well, because if you even in this time frame where you have 2008 and what we've witnessed here so far into 2020, the balanced portfolio approach is still the place to be for returns over the long term.
So Matt, what you're saying is someone who would be invested, stay the course from 2005 through just yesterday or last week, they would have experienced an annualized rate of return on their portfolio of about 6.6, and that is despite having gone through the 2008 financial crisis where their balanced portfolio was down 25%, and also having experienced a decline of 14.5% for this year alone. So that is key, and this is why we really hone in on making sure that the portfolio allocation is appropriate for your goal, and going back to the goals-based approach to investing, because trying to time the movements in and out of one particular sector can really prove to be basically a failing approach. And you'll see the boxes are all over the place. So while cash may be pegged as king, that only holds true in years where we do have some sort of a crisis in our hands. But long term, you'll see that cash has yielded during that same period from 2005 to 2019 would have an annualized return of 1.3%. Versus a balanced portfolio, which would have yielded 6.6%. So again, just really making the case for the benefits of appropriate asset allocation and really not trying to time markets going from one sector to another.
Yes, absolutely. And we'll dive into that a little bit more. So let's turn to the economy. And this is a chart from McKinsey. Again, really what we've witnessed, we believe that the market has priced in a lot of the bad news already. As far as the next quarter is concerned, they could pretty much just throw away the second quarter as far as how bad the economy is going to be. It's really now about how much the virus gets contained, and also then getting out of this economically. So there's different types. There's all different types of of recoveries. There's an L-shaped recovery. These are going to be pretty much L, U, and V. An L recovery is picture the letter L, where we've gone straight down and then we just don't recover for long periods of time. And that's just a complete just breakdown of the economy and the government support and the healthcare system. And we don't believe that, but that's just one,
That's on
one,
the worst case scenario.
Right. And so then there is the more optimistic side of things, where it's more of a V-shaped, where it's going to be, it's going to be nasty and it's going to be a quarter or two of pain, but then we're going to see a very strong economic bounce back. And then somewhere in the middle there'd be a U, where we're going to have a downturn for sure, maybe 6 months to a year's worth of meddling, slower economy, maybe a pushback or a bounce back, but then eventually we're going to push back and the economy is going to recover. So.
And I think, going back to the hurricane type analogy where, nothing's changed with the hurricane. It's out there. It still looks powerful. It's inching closer to the U.S. and us having felt the first outer bands of the hurricane by way of the unemployment claims for last week of 3.3, which is a number never before seen in history. So, we suspect that we will have more of a U. We're going to see that decline in the second quarter, maybe kind of hover around the bottom while we kind of get the healthcare crisis under control, and then see that economic recovery. So I do want to point out, Matt, just, there's economic recovery and then there's market response, and, maybe tying that in, and that's where we'll slowly get to that in a couple of slides down. But we're talking about the economy, and in a little bit, we just want to make sure that we then look at how the market responds to the economic outlooks, which is two separate things. So on the economy, we expect more of a U, kind of hover around the bottom while we get this thing under control. And then later we'll go over what we expect markets to do.
Right. So even again, we leverage the best and the brightest and the big financial institutions as best we can to come up with our analysis and how we manage our portfolios. This Vanguard, which is one of the largest money managers here in the United States, they put out a forecast which is more V-shaped. Basically, again, we're going to see, and everyone just needs to be prepared to see some really nasty economic data coming out in the next couple of months as it relates to the growth in the second quarter. This is not all rosy. We are going to see a recession here in the United States where, the GDP could be down on a -10 to -15 to -20% basis. And I do think with what the government's doing to help kind of stave off a really traumatic financial crisis, that we're going to, once we get some sort of control of the virus and somewhat return the life back to normalcy, we'll have a pretty quick shot up and pin up demand and have the economy recover. So, it's hard to see right now with what we're dealing with in the news and the healthcare crisis, but a lot of economists out there are predicting a really significant trough and then some great growth on the back end into the latter parts of 2020 into 2021.
Right. So, again, I'll just remind people that while you see that spike decline there, which is what we expect to see in the second quarter, again, this is where the CARE Act is going to play a very important role in trying to hold us up to some extent with the worker benefits as well as business incentives to keep people on the payroll. So that's just two key things to note here.
So a little historical perspective on bear markets. This is dating back to 1926, where you can kind of see different depths and different lengths of bear markets. The Great Depression was down negative 80% with 34 months ago. And we just don't see that happening with what the government, it was a different time period, a different way to handle things. What they were doing back in the 1920s and 1930s was on the tools and the technology that we've learned and how economies work, and just the fact that we're just throwing so much at this to really make sure that it's going to hurt, but it's going to hopefully be as temporary as we can make it, And frankly, I don't think the government, Congress is really going to be even done with this last, even a $2 trillion package. I don't think that's going to be the end of it. I think that was more of a stabilization type of measure. And then in the future, we'll even see more growth measures. But over the long run, bear markets are typically, on average, down about 40%, and last on average about 22 months. We are just in the beginning stages of our bear market here, where we were down at the lows of about 35%, and we're only a month or two into it. And so this one may be quicker because we have a kind of a known issue, and once that known issue is taken care of, I think we'll get back to business pretty quickly. So I'm hopeful that it's less than the average of 22 months. But that's just some food for thought of what the historical bear markets have looked like.
Yeah, and I think maybe, I don't know if you were going to cover this later on in terms of timing and the dangers of trying to time movements in and out of markets. And I think the key part there is that usually the worst market days are pretty much followed by the best market days. And I think we might actually have a slide on market timing now. Right. Here we go.
Well, this one is about this one's more about staying the course. This is a 60-40 portfolio, 60% stocks and 40% bonds. And, a lot of our clients have lived through these already. October 87, the stock market crash. 2001, we had, terrorist attacks. 2008, we had major Wall Street banks failing. Which, we don't foresee happening at this point in time with the support given by the government. But you can see after 1 year, 3 year, 5 year time periods, the stock markets are up from the big drawdown. So we got to keep that in perspective as we're trying to make our decisions here as to how we're managing portfolios and what we need to do with our clients' money and helping them achieve the goals that they want to achieve in life.
Yeah, now I'll just put, I like to paint the picture. So one way to look at it is, in order for us to see the rainbow, we almost have to go through some storms. So this, again, going back to market timing, if we become emotional and we allow our emotions to help us make financial decisions, they may not be in our long-term interest. And again, this is because just history shows that the worst markets are usually followed by the best market days, and they're in clusters. So almost picture that as the rainbow following the rain. And us trying to time that particular market movement could serve not in our best interest.
Absolutely. I mean, I think it's one of the questions that we're getting most frequently is how bad is it going to get? When is this going to be over? And frankly, it's hard to time. We can't time. It's next to impossible. There's just so many variables. There's so many things happening that you have to just stick to the plan that you have and that you've determined during a calm period of time. And we'll talk about that, just how we do that for clients. And right here we go. So we talk about, what are your goals? What are we investing for? And what is your time horizon? Time horizon is pretty much one of the main components of developing an investment plan, an investment portfolio. Determining when you need what you need is the ultimate goal. So, we first think about what our clients are going to need in the shorter term and make sure they have a good reserve just in the bank account. That's kind of typically known as your emergency fund. And then we have other different types of buckets where if you have medium-term goals where it's something to buy a home or pay for college, we'll invest a certain way. Then they have longer-term goals of 15 years or more, maybe retirement or I think a lot of advisors today, including us, believe that even though you are at retirement, that's not the end of your investing life, because you need to be able to sustain yourself. Let's say you retire at 65, and let's just going to say that you're going to live out the good old age of 100. So you need 35 years of growth in the portfolio to help sustain yourself. So most of our clients will have some equity exposure along the way, but getting the goals right and knowing what needs to come out of the portfolio is very important to determining how we build the portfolio.
So I think, times like these, as painful as they are, they really help us put plans to the test, on so many different levels. Is the plan right for you from a cash flow management, right? So we have a few clients already where they've turned on the switch on distributions from the portfolio. And here we are. We've always talked about what we allocate to our safe bucket so that in times of turmoil, we can ensure that we're going to have a good period of time to be able to continue those monthly cash distributions without any impact to their current lifestyle. Yet, we've allocated to the equity the piece that really needs to be able to work behind the scenes. So once you have that mixture of fixed income to equity, right, and we can see that we have a really nice runway to allow our equity portion of the portfolio to recover, this is when you've tested the plan. This is what we talked about, that, recession period, bear market. How do we plan for that? So periods like this, as nerve-wracking as they are, they really allow us to put an entire plan to the test. And these are the moments where we think, do we need to pivot? Do we pivot because maybe you're losing sleep over market volatility? Is this the right portfolio for you? So remember, portfolio design and allocation is made up of so many components, from risk tolerance to your goal to the time horizon. And this is the moment where we're basically, the rubber meets the road in our ability to test what we've put in place and whether this is still appropriate for you.
Right, and this is kind of just a chart saying the different types of portfolios that you may or may not be in, where this is data going back to 1997 through the end of 2019, and I'm going to pick on a portfolio that has 90% in stocks and 10% bonds. Well, during this time period, you've seen the worst times, at the worst of times, a negative 36% return, and the best of times, a 32% positive return. But over this long time period, you've seen on average an 8.8% return. And those are for folks that are, that type of portfolios for folks that have a long-term time horizon or have unique circumstances where they're willing to ride some of the ups and downs a little bit more.
Right, and they're going to feel it a lot more, Matt. Mm-hmm. But if we think about why that particular allocation may have been chosen, when we sat in a calm room, hopefully calm, and we walked through the investment policy statement and we talked about why a 90-10 may have been more appropriate than a 70-30 type portfolio. So many factors outside of the portfolio itself may have been taken into account. So again, in moments like this, we need to be able to zoom out and put things in perspective and look at the whole picture, so that we're not just looking at, with the blinders on what's happening with one particular item of our entire plans.
Right. So some tips on what we're doing and what not to do or what to do during the bear market is don't panic. Don't be fearful. It's hard to do, especially in these times, but a well thought out asset allocation and diversification strategy is the fundamental ingredient to good investing. And so that we can't let fears today derail our long-term goals. And this chart here is one Nella alluded to a little bit earlier, just about staying invested, where if you miss one day of positive stock market returns, the best one day, your overall returns go down. And if you miss the 25 best single days from 1990 to 2029, you had an annualized return of 5%, whereas if you just stayed still, totally invested the whole time, it was closer up to 10%. So you almost cut yourself in half. It's difficult to do. It's hard to try to time it. We know that is one of our core philosophies. Is just, there's been plenty of times throughout the last 20 years or 40 years that we've been in business that we've had to really just stay the plan, and sticking to the plan is the best approach. So as Nella mentioned earlier, some of the worst days are right next to or pretty close to, within a week of, some of the best days. And getting in out on a Monday and telling yourself to get back in on Friday, it doesn't really work that way. We've seen it over and over again with clients who try to do that. It usually does not help long-term results. And case in point, this chart here is from just a more recent example from when 2018, if you remember the end of 2018, we had a pretty nasty drawdown there at that time as well, where from somewhere around August 2018 through Christmas Eve, we saw pretty much a bear market, pretty close to it, about 20% drop. And you can kind of see here, someone that stayed invested in a traditional 60% stocks, 40% bonds, yes, on the low of it on Christmas Eve, and you sold out at Christmas Eve, you only had $943,000, and you didn't experience and you weren't rewarded with staying the course into the positive year we had last year, which was 2019. So if you also went to cash just a week after the lows, after the first initial bounce up, you had $973,000, which is the green line in this chart, so on and so forth. And even if you were just out a week, you went to cash on Christmas Eve, the purple line for about a week, got back in on January 2nd, you're up to $1.9 million. But again, staying invested, staying the course, and it doesn't mean stay the course and not do anything. We're going to talk about rebalancing here in a moment as well. What we want to take advantage of these downturns as well.
And planning. I mean, I'm sure I told some of you on the call. I joked that in December 2018 it was the tax gods responding to my need to harvest losses. So again, it's this idea of looking for pockets of opportunity and strategically possibly making those paper losses into real losses, but staying invested. It's not going cash and then, hoping to time in the perfect time to get back in the market.
Again, turn out the noise. Stick to your plan, turn out the noise. This is a chart from 1970, and there's been scary times in our life where we've had just so many different things occur. Hurricanes Katrina and Rita hitting in the same year. Back in 2008, again, S&P 500 down 46%. Technology bubbles crashing. We had Business Week way back in the 70s declare the death of equities. and just to look what the green line did, which was the stock market just staying invested. So I don't want to make light of the situation that we're in today, but realize, take a deep breath, is that the world will figure out a way to adapt, and capitalism will continue, and we don't want to be not on the train when the markets do recover and the economies do recover as well. Again, stay focused for the long term. This is again from Vanguard. I think I'll just draw your eyes to the right side of the screen here, where as recently as the end of year of 2019, with where valuations were today and where stock markets were at that time, based upon their modeling, a 10-year return was somewhere around 4.4%. Today, as of March 12th, during this downturn, that has made it more attractive, and now their forecasts are saying more about a 6.8% return over the next 10-year expected return. We're not here to tell you this is the bottom. We're not here to tell you that everything is going to be smooth in the next 2 months, but we have to remind ourselves that in the long run, if you're investing for your goals properly, this too will be a time period that we're going to recover from. Right,
and a lot of our clients, you're able to take advantage of the dollar cost averaging. You're still, putting into your 401ks. I had, quite a few calls with folks who had cash on the sidelines that we've started infusing. So again, this just presents an opportunity to be able to enhance portfolio returns over a long period of time. So what can we do, Matt? What's next?
Okay, so, this is where we will have to, we got to stick to our plan. This is really what we want to communicate, is that we're going to, it comes with the planning. Now, I mentioned it earlier, tax loss harvesting, and just as a reminder what that is that we will strategically take losses in some of the funds that we own and repurchase similar funds, but not exactly the same, similar funds that you're getting mostly the same exposure, and that you're booking the losses for tax purposes, and then you reinvest on the way back up. And so from a tax perspective, we're trying to take advantage of these opportunities.
Right, and you may or may not need them this year. I've had a few clients that have had gains from activities outside of the portfolio, if that's a sale of a business or something like that. These losses are going to be, true out-of-pocket savings for them. So for them, they'll be able to use it. Otherwise, we'll basically bank them, and we'll fill up a nice little bucket full of tax losses that we'll be able to use as we have gains in the future.
Right. So rebalancing is a term we use frequently. It basically means that we are going to be buying. But what a lot of clients are wondering what we've been doing to combat this, and they are surprised. Some of them are surprised, but most folks know that this is our strategy. We're actually buying some stocks or repositioning ourselves. We're taking some of that fixed income bucket where it's been not as gone down as much as the stock market, taking a little bit at a time out of there and buying into stock markets and stock funds across the different types of asset classes. Again, we did it. You do it continuously. You're not trying to time the bottom and say this is the right time. You don't do it near the top. You do it as a phase-in approach. And with new money, we've been doing that as well. If people come to us with new money, we try to kind of phase it in over different time periods depending on that client's needs and circumstances.
And it's not just phasing it in and, sort of robotically, which I think is important for you all to know. You cannot do this robotically. It's, looking for those pockets of opportunities. And that's where maybe we could go into a little bit about, what do we do now? What are some of the moves that we should be thinking about in portfolios? So that is the flock to quality is pretty much the theme here.
Absolutely. No, that's a major component. It's not that we're saying here that the economy is going to get rough. So what type of companies do you want when economies get rough? So you want companies with not a lot of debt, companies that are going to be around when this is over, companies that have strong earnings and a good opportunity to continue to service their market and to keep their revenue. Yeah, the revenue might be down, but they're going to be able to weather the storm. And that's quality stocks here in the United States, different types of companies that are represented by quality, or your typical stocks like Apple, Johnson & Johnson, things like that. And of course, we're buying funds, but quality approaches are definitely what we've been trying to utilize for our clients, and that's where one thing that is one opportunity. So another things that we're looking into is just opportunities that come along in the different sectors. Maybe we will shift to different types of the sectors that we went over earlier. Maybe energy will be attractive once the supply and demand have kind of leveled out. These types of things. We're not saying that we're doing it across the board at this exact moment, but we're looking and we're going to be ready to do some opportunistic shifts over the next few months, where when the economy is looking pretty bad, there might be some opportunity out there in the stock market to take advantage.
Right, and I just want to point out, and I think that the reason why we have that laser focus in opportunities in the market is the markets, as you saw, they're a lot quicker to price in economic outlook. So as quick as it was to price in the impact of the coronavirus, it could turn around and as quickly price in the economic outlook, which may look more like that U-shape that we had talked about before. But the market will be a lot quicker to price in the outlook for the economy.
Yeah.
And so we want to try to capitalize and really look to invest in these quality companies while they're in that discount realm.
Yeah, point in fact, we mentioned a little bit earlier, the last week's job claims number was 3.5 million, a number that we haven't seen before. Well, we might have to see a few more of those, but what was the market's reaction? It was actually positive. We had that, it was kind of priced in, and you wonder just how much of the bad news is already priced in. So we have to be aware that once some of these external factors get priced in, that the economy and the markets are going to recover. And then, what we really, from a planning side, outside of the portfolio, is because, we are true wealth managers and financial planners, we have to look through all these new stimulus packages and bills that have come out. We are going through them as best we can. We're going to highlight a couple points right now for you.
Points, yeah.
We probably will have at some point entirely different webinar, some information out to our clients and our followers to make sure that they're staying informed
Yeah.
But one of the things, and I'll let Nella
And,
go ahead.
and we could spend another hour on this, so we'll just kind of highlight a few things that are important to you all is, the tax filing and tax payment deadline has automatically been moved to July 15th. So that's a big relief. Having said that, we do want to, for those clients who just, all the information is available, we do want to get those tax returns filed as soon as possible, especially since you may have already heard that in the stimulus package, they will be sending out rebate checks to families, and that's going to be driven by 2018 return if 19 isn't filed, or 2019 once it's filed. So if you end up fitting into the criteria for those rebate checks, and that's a conversation we can have individually in terms of whether you should expect a check or not. There are going to be tax credits for employers who have to pay employees who have to go on family leave, either because they may have tested positive for the virus or they're taking care of a family member. And then on the CARES Act, there's a lot here. So again, we may just hold another session just to go over this. But some of the benefits for probably our hardest hit sector, which is the business owners, is that they will be providing federal loan packages with some forgiveness components attached to them, as long as they keep all the employees on the payroll, and that's because they don't want to overwhelm unemployment, so they're trying to relieve some of the pressure by having companies continue to pay their employees even if they're actually not able to go to work. So they'll all sorts of incentives. Unemployment benefits have been increased. So across the board, as I said earlier, the Fed really threw everything but the kitchen sink at this. So we'll continue to monitor this, and this, as Matt had mentioned, maybe just be phase one of what they're going to do to try to keep us operating in some sort of suspended animation. And I think that's just such a good picture of essentially what's happening in the world today. So that pretty much concludes our presentation.
Yeah.
We'll see if we have some questions here.
So one question that we're getting coming in, or a point that is really about the low bond yields out there, and how that's going to affect the markets. Well, you can kind of see the Fed has, on the short-term side of things, basically brought the interest rates down to zero, and that's kind of filtered through other parts of the bond markets. The 10-year market, the 10-year bond is under 1%. I think coming in today was somewhere around 0.75% on the 10-year. And, I think that's just really a couple things is going to be a result of low interest rates. I think it's going to be lower for longer. I think, again, I don't think they're going to be in a rush to raise interest rates in the long term. So I think you're going to have time to potentially refinance that mortgage or refinance that auto loan. But I think more importantly, from where the markets are concerned, I believe that that'll also help having the bond yield at such a low. I think that'll also help kind of mitigate the downside in the stock markets, because the stock markets are paying the 2.5% dividend yield, and so you're getting 2.5% from a yield from the stock market side, but you're getting less than 1% on the bond side. So investors are going to have to go out there and look for some stability of earnings and some stability of cash flow in the form of dividends. So I think that's going to be an opportunity there for the stock market to maybe not have such a drastic downside in the next few months. But that's one idea with the low yields and how that relates to dividends.
Okay.
So I think that is all. If anybody would like to contact us, we are, of course, here and available for you at all times.
And just as an update, we are so we're in the office, Matt and I, and we're pretty much alternating. We may have already notified a lot of you if we've had calls in the past couple of weeks, but we are operating in the office with the skeleton crew. We try to have no more than 4 people, and it's very strategic. It'll be someone from our portfolio for any trading needs. Matt will typically be in. We've had head of operations, so Edgar will be in just to troubleshoot any technology. And then Lily, who's been answering phones, she'll come in every once in a while, collect mail and things like that. So we're fully functional. All of the advisors, we've actually had them all work remotely because our technology allows for that. So fully functional, feel free to, call us as business as usual here on our end, in terms of being able to service you. We don't ever want you to feel like you're in a situation where you need to get a hold of us and you're not able to. So we're making every intention throughout this to always have someone in the office and always be available, whether that's here or remotely. So with that, thank you all for tuning in. Again, if you have any questions, please call us, and be sure to be safe and take care of yourself. Use a lot of hand sanitizer and wash your hands. And I think the most important advice I can give you is keep your hands off your face. I keep reminding myself that every 5 minutes. So be safe, everyone, and have a great afternoon.
Take care.